is our first tutorial under national income accounting using the expenditure methods. We have Cameroon GCE 2007. The question said, using the figures below, answer the questions that follow. And they said all figures are in millions of francs CFA. So we are not going to read all of this, but we'll go straight to the question. The first one says we should calculate total investment. Now, one thing to note to all of you students is you should never use net investment to calculate national income. Always use total investment or gross investment. That is the initial investment. Because net investment simply means the present financial value of an asset as of now. If I bought my phone, for example, for 10,000 francs, and then I have used the phone for 3 years, and I can sell that phone now, after 3 years, is worth 5,000 francs. It means that the net investment of my phone now is 5,000, but that is not what I initially invested. So if I want to calculate how much I have spent on things, or goods and services, for the past 3 years, I need to add up the total investment, the original or gross investment that I made into that phone. So take note. So they have asked for total investments, but here we do not have any value of total investment. We have net domestic capital formation, and capital formation means investment. So they have given us net investment. So how do we calculate gross investment? Let me abbreviate it, GI. Gross investment is calculated by, we take our net investment plus depreciation. Why do we add depreciation to net investment to get gross investment? Simply because net investment is the present value of a commodity after depreciation has taken place. So to go back to the original value of that good, we take the present value plus how much has been lost to depreciation. That will give us our gross investment, our original investment we made. So in this case, we have net investment, which is given, and then we have depreciation, which is also called capital consumption, which is given. But then we are not only going to involve capital consumption and net investment. We also need to look at the value of stock, because they have told us that the value of stock on the 1st of January 1968 was 70 million. Remember, everything is in millions. While the value of stock on the 31st of December 1968 was 50 million. That shows that what? That shows that there has been a negative change in the value of stock. There is what we call stock depreciation. When the value of a stock depreciates, it simply means that the prices are falling over time. When they appreciate, it means that the prices have risen over time. The prices of goods already produced and kept, they have risen over time, and that can falsify the national income values. So what we do is that we always subtract stock appreciation, and we subtract stock appreciation, and then we add up stock depreciation. So in this case, we are going to take the value of the stock at the end of the year minus the value of stock at the beginning to see whether we had a positive or a negative change in the value of stock. Then that will affect our investment. So we have gross investment is equal to our net investment here, which is 30, plus depreciation, which is 10. And then we have change in the value of stock. So we have the value of stock at the end of the year, which is 50, minus value of stock at the beginning of the year, which is 70. Everything in millions. Gross investment is equal to this plus this gives us 40. 50 minus 70 gives us negative 20. So 40 minus 20, our total investment is 20 million francs. That is our first response. 20 million francs. We are good. The next, they say we should calculate total domestic expenditure and market prices. Now, when they ask you to calculate anything and you hear market price or factor cost, what does it mean when they talk about market price? Market price simply means the financial worth of a good when it is already in the market, having already been affected by taxes which raise the price of the commodity, and also subsidies that reduce the price of that commodity. When goods are existing in the market, if I produce this pen, the market price of this pen will not necessarily be equal to the cost at which I produced the pen. Why? Because when it reaches the market, the government would have levied taxes on it. I will take those taxes to add up to raise the price of this pen. And then the government might have subsidized this pen. Those subsidies will do what? They will reduce the price. So subsidies reduce prices in the market, and then taxes raise prices. So that is what market price means. Then factor cost. Factor cost simply means the expenses that were made to gather factors of production to realize that good. Which means that what? At that time, no subsidies have been granted. Subsidies that normally reduce prices have not been granted. Which means that to go back to factor cost from market price, we add up subsidies. Taxes that normally cause prices to rise have not been imposed because we are still looking at the worth of this pen as per the factors of production I spent. So to move from market price to factor cost, what do I do with taxes that normally raise prices? I subtract taxes. What do I do with subsidies that normally reduce prices? I add subsidies to move from market price to factor cost. Then I do the reverse when I'm moving from factor cost to market price. Let's see what that means. So, 2, we have been asked to calculate total domestic expenditure. And total domestic expenditure simply is given by consumption plus investment plus government expenditure. So we have our values. So what we simply do is total domestic expenditure at market prices is equal to consumption. This is consumer expenditure, 140 plus investment. We have had our investment here to be 20 million. Remember, we are not using net investment, we are using gross investment, which is 20 plus government expenditure, which was given. They said government final consumption. The government consumes by spending on public and merit goods and others. So we have that 50. And then our total domestic expenditure at market prices, or market price, is 160 plus 50. This gives us 210 million francs CFA. Simple. Now, we go to our third exercise or question, which says we should calculate the total final expenditure at market price. We said that to get total final expenditure, we simply say consumption plus investment plus government expenditure plus exports. So the only thing that is changing between total domestic expenditure and TFE is that we've added exports. So we can still say TDE plus exports gives you TFE. So we just take our TDE here, which is 210 plus our exports. Let us see what was given as the value of exports, 45. So that gives us our total domestic expenditure to be 255 million francs. Alright? We go to the next, which is our gross domestic product, still at market price. So GDP at market price is equal to total final expenditure at market price minus import. Or you say GDP is equal to C plus I plus G plus X minus M. So the only thing that is lacking from TFE to make GDP is that imports have not been subtracted. So we just subtract import. So we take the same value which we have for total final expenditure, 255 million minus import. The value of our import here is given as 40. So we have 255 minus 40, that gives us 215 million francs CFA. So that is the value of our gross domestic product at market price. Let us now see how to calculate gross national product at market price. So your gross national product, which is our fifth exercise or fifth question, GNP, still at market price, is gotten by GDP at market price plus or minus net property income from abroad. Or if you want to take a straight line formula, you say that GNP is equal to consumption plus investment plus government expenditure plus exports minus imports plus or minus net property income from abroad. It is the same thing. So we have gross national product at market price being equal to our GDP at market price, which we just had to be 215, and then we add or subtract net property income from abroad. Now, our net property income from abroad has not been given as one figure. They have separated it into two. We have property income received from abroad to be 35, and we have property income paid abroad to be 30. So what we are going to do is, remember we say the formula is property income received from abroad minus property income paid abroad. So what we do here is we say GNP at market price is equal to 215, which is our GDP, plus or minus property income received from abroad was given as 30, then property income paid abroad was given as property income received from abroad is 35, while property income paid abroad is 30. Alright? So this gives us our GNP at market price 215. 35 minus 30, it gives you 5, which is positive. So the positive sign overrides. So we have plus 5. Your final answer is 220 million francs. 220 million francs. That is the value of your gross national product at market price. Now, interestingly, they have asked us to calculate gross national product at factor cost. And I said that factor cost simply refers to the financial value of goods and services in a country as per what was spent to gather the factors of production, when the government has not yet imposed taxes to raise the price, neither have they granted a subsidy which reduces prices. So to move from market price, remember we've been calculating everything at market price. So to move now from this market price back to factor cost, we need to remove that thing that made prices to rise in the market, which was taxes. Of course, indirect taxes, because sometimes they will confuse you and they will put direct taxes. Under national income accounting, make sure that you work only with indirect taxes, even if they give you direct taxes. While under the secular flow, which we are going to see much later, work only with direct taxes, even if they mix up the two. Do not use indirect taxes under the secular flow of income. So, to convert gross national product at market price into gross national product at factor cost, what we will do is that taxes which caused prices to rise in the market will be subtracted, while subsidies which normally cause prices to fall will be added, so that we move from the market back to the factor cost. So this one will be gross national product at factor cost will now be given by gross national product at market price, which we have solved and had here. So what we are going to do is we will be adding subsidies that caused prices to rise, and then we shall we will be adding subsidies that cause prices to fall, and we shall subtract taxes that cause prices to rise. So GNP at factor cost is equal to GNP at market price, which is 220 million, plus subsidies. We have been given subsidies on goods and services to be 40, and then minus taxes, we've been given the value of our indirect taxes, taxes on expenditure to be 60. So our gross national product on factor cost, or at factor cost, is this plus this, which is 280 minus 60. 280 minus, or 260 minus 60 gives us 200 million francs. So that is the value of our gross national product at factor cost. You can see that goods or the value of any good or the value of national income or GNP at factor cost should normally be less than how it is in the market, because when goods get into the market, the government must have levied taxes, and oftentimes government taxes are higher than the subsidies they grant. That is why you see factor cost is GNP at factor cost is less than GNP at market price. And then the last thing that we are supposed to do is to calculate national income. National income. So we always note that your national income should always be calculated and left at factor cost. Alright? Your national income should always be left at factor cost. So what you do is, you see, the straight line formula for calculating national income is consumption plus investment plus government expenditure plus exports minus imports plus or minus net property income from abroad minus capital consumption or depreciation. But then we know that from here to there is GNP. C plus I plus G plus X minus N plus or minus net property income from abroad is the formula for calculating GNP. And since we said that national income should always be calculated at factor cost, good enough we are just from having national income at GNP at factor cost. So what we will do is, we just say national income now will be equal to GNP at factor cost minus depreciation or capital consumption. And that is simple. National income here will be equal to GNP at factor cost is 200 million. Then we subtract depreciation. They told us that our capital consumption was 10. Depreciation is the same as capital consumption. So 200 minus 10 gives us 190 million francs CFP. That is our final answer for national income. Thank you so much for following up. Let us see what you think about this exercise. If you have any worries, drop it on the comment section and then we shall bring the responses to you. Let's look at